Okay, we're going to talk a little bit about capital budgeting here and look at those and see how it fits in and how it is used. And particularly with capital budgeting, what we're going to be spending a little bit of time with, especially with the problems, is looking at how to do the time value, how to use time value of money, particularly with net present value and internal rate of return. Well, first of all, theoretically, capital budgeting is part of the planning process. And what I mean by that is that if you go back to what we talked about in the original budget chapter, good companies will create a strategic plan. And part of that strategic plan is to recognize opportunities where they can expand. And part of that expansion is going to be, or even might be, to the replacement of long-term assets. So capital budgeting is basically a long-term planning process for bringing in new capital equipment. And when I mean capital equipment, I'm talking about something that will have a multi-year life and generally something too that is rather expensive. Now, it could be simply the replacement of current machines. As they get old, they need to be replaced. It could be the expansion. And one of the big challenges with capital budgeting is not only identifying how, when, and where you're going to replace machinery or expand production, but how am I going to pay for it? And so, generally speaking, replacement comes from current operations. Expansion is probably going to have to come from the capital markets. That is, companies are going to have to look at issuing stock, issuing bonds, and that can be a very expensive proposition. And given the cost of that, you don't want to have to do that too often. So part of it is finding that kind of nice sweet spot where you are expanding and meeting anticipated demand for your product, but at the same time not going back into the capital market too often and incurring unnecessary cost. And part of it too is you want to make sure that you get the right machines, the right capital assets that will allow you to not only make the product that people want to buy, but also make it as efficiently as you can, and so that you can keep your costs down, keep your profits up. So again, it's long-term planning, and it's about projects, and that is capital projects, things that are very expensive, items that have a multi-year life. And so it does create a degree of uncertainty predicting what that's going to be. Now, capital budgeting, too, also always involves looking at cash flows. We're not going to really, other than one of method, accounting rate of return, but in the decision, do I buy this, do I not buy it, we're looking at cash flows. Generally speaking, cash is king. So part of the process here, in addition to identifying machines and things like that, is to identify what the cash flows might be. It could be from expanded sales. Generally, replacement of machinery, we're looking at cost savings. Generally, newer machines may tend to be more efficient, using less materials, less labor, etc. So those things can help pay for, help finance the replacement or even the expansion. Now, I think we'll look at this in terms of the little diagram here. When you do capital budgeting, it's always going to be an ongoing process. Given the strategic plan, that we need to replace machines, we need to expand production. So with any particular project, this could be machine M, machine N, whatever, I'm always going to be in the midst of different planning and evaluation. And so if I have already implemented Project M, that is, I bought the machine, or I made the Expand U factory, well, maybe that was done last year. And now what I want to do in this year is take a look and decide, well, are things proceeding the way they're supposed to? Are we getting the anticipated cash flows that we thought we were going to get? If not, what are we going to do about it? Now, Project M, you're looking at this as the last year. Not a whole lot you can do about it. Now, as you're going forward too, there may be additional projects that you might be evaluating, such as Project R, okay, Q, R, S, T. And so these are things that we're going to be planning, if we're looking at 2015, that we're going to look at moving forward so that we can bring them online at some point concurrently with all the other projects that we're undertaking, so that these things tend to be simultaneous rather than sequential. So one of the challenges is to track all of these things. Now, at the end of the life of a project, okay, Again, I can't do a whole lot about what has already happened, but I can go back and sort of audit the decision-making process and look at it and say, okay, what did we do right? What did we do wrong? How do we change that process going forward so that we make better capital investment decisions? Now, I think all of this is fairly straightforward. These 5 stages are going to be integral to that diagram that I just showed. You need to identify projects, and this is going to be always consistent with a strategic plan. That is, we don't want to take on an investment that really has nothing to do with what our strengths are in our company. So kind of staying to your strengths, staying to your strategic plan. Gathering information, and this is going to be part of the accounting function, helping people identify cash flows, inflows, outflows associated with investments. Part of what you may do in cost accounting and financial area, making predictions. Well, okay, what do we think the savings are going to be? What do we think the cash flows are going to be? Cash flows going in, cash flows going out. Now, you may or may not be involved with actually making decisions. At some point, you have to decide. We've identified the inflows, we've identified the outflows. From a cost-benefit point of view, what do we do? Do we say yes to it? Do we say no to it? Do we choose A over B? And at some point, you have to make a decision, and that is, let's implement it. And part of it is, this is an important step that oftentimes people sort of take for granted. Well, we said it, but a lot of times companies screw up big time in that they made the right decision, but they didn't implement it properly. And so that becomes an important element of making sure that that we actually not only have decided on the proper investment, but did we do it appropriately? Now, when capital projects are undertaken, in addition to the cost of the machine, the cost of capital, etc., oftentimes it requires some additional or incremental cost. And generally such as I may need more inventory, I may increase my sales, so that means, again, my raw materials may have to increase. If I'm keeping safety stock, if I'm increasing sales, sometimes my receivables will go up. So again, these are going to be additional cash outflows that I'm going to have to factor into the cost of the machine initially. Now, we're going to look at basically 2 different ideas here. One being the net present value internal rate of return, which look at this via the cost of, or looking at it in terms of time value of money. Payback, accounting accrual, okay, don't involve discounted cash flows. Now, again, I'm not going to get into the theory behind what you're doing with discounted cash flows or the time value of money. You've probably done a lot of that in both the intermediate and finance. But the whole idea behind discounted cash flows is that $1 today is worth more than $1 tomorrow. And I think particularly here, this kind of illustrates it very well. And that is really these 2 things are equivalent. That is, $1 today, given that I could potentially invest it at 10%, is equal to $1.10 1 year from now. Why? Because I could take that dollar, invest it at 10%, it would grow into $1.10. Or another way of looking at that $1.10 that I'm getting 1 year from now is really only worth of today's dollars $1. So they tend to be reciprocals of one another. When I'm looking forward, okay, and saying what's this dollar going to grow into, we're looking at that in terms of future value. When I'm looking at the $1.10 and saying what's it worth today, that's the definition of present value. Future value is always looking at what's this amount going to grow into in the future, and that is going to become greater. Some amount of money that I'm getting in the future, if I'm asking what is worth today, it is present value, because essentially the present value is going to be less than the amount that I'm getting in the future. So the opportunity cost, yeah, okay, that's a little bit tricky to look at, okay? What we're going to be concerned about here, the required rate of return will be given to you in the problems. It can be calculated a couple different ways. Excuse me. One can be the weighted average cost of capital, and that is if I take all of my financing, short, often long-term, given the various weight, what it cost me, what's that weighted average cost of capital. Some people will say, what is the incremental cost of capital? That is, if I have to go into the market now, to the stock market or bond market, what is the required rate of return? And so there are various ways that you can calculate this, various ways that you can assume what that cost may be. But for your part, you're going to be given this amount. Now, net present value is probably the most popular version of the time value of money calculations. It's kind of a simple cost benefit. And what I'm looking at here basically is kind of an inflow-outflow proposition. And that is, I'm looking at the cost of acquiring a new machine today, in today's dollars, which would have the present value of 1. Then the assumption is I would buy this because it's going to generate cash flows coming in over a period of time. So I take the present value of those cash flows and look at it and compare it with today's cost. If the present value of those cost flows is greater than today's cost, it's acceptable. It has a positive net present value. If the present value of those future cash flows is less than the cost, it would have a negative net present value. It would not be an acceptable project for me. Because my decision criteria would basically be accept any project which has a positive net present value. Now, I think the best way to look at it is to look at this example. And you may have to expand this a little bit. But the initial cost is $648,800. And that's the initial outflow. And, okay, I'm going to expand this a little bit here. So they're going to get $180,000 each year. So this is the outflow that occurs right now. So it's going to have a present value of 1. So at the end of each year, they're going to receive $180,000 from it. Now, again, each of these $180,000 needs to be discounted. So you can do this via Excel, you can do it via a calculator, you can do it via a table. This is the present value of 1 because it's a one-time distribution that I'm going to receive at the end of the first year. And at the required rate of return of 8%, look at the 8% column at one period, you would find the factor here. And just keep doing that across the board. And you would find that if I add all these up, okay, the net present value is the highest, a little over $60,000, which is a pretty substantial amount. Now, I could also recognize this as an annuity. Why? Because I'm also getting the same amount of money each year. So when that happens, okay, I can go to my present value of annuity table at 8%, in this case for 5 periods. I come up with this factor here, multiply 180 times that, come up with 718,740. Okay, I still have a pretty substantial amount of money coming in here, over 60,000 net present value. So my answer would be yes, I would accept this as a viable project because it has a positive net present value. All right. Now, internal rate of return is a little bit more tricky to do. The idea behind internal rate of return is that you want to make the net present value equal 0. Remember that with net present value, I was given the required rate of return. I discounted the cash flows. And so my decision criteria was, hey, anything that ends up being positive net present value, I would accept. Now, it also means that if I have a pretty substantial net present value like I did before, that the investment itself is probably returning something substantially greater than 8%. I don't know what, but that's what I'm trying to figure out with internal rate of return. I want to make the net present value equal 0. At that point, what we've discovered is what is the true return of this investment. And I will then take that and whatever that percentage amount is, compare it with my required rate of return. So if the investment is coming back at 12%, if I'm demanding a 10% return, I would have an acceptable project. Again, if my required rate of return is 10%, but when I calculate internal rate of return, it comes back 8%, I would reject it, because in that case, I would lose money. So the idea here is internal rate of return is kind of tricky to do. You want to make the net present value equal 0. So you have to kind of give it an interest rate here that you're going to kind of play around with here. In this case, they kind of said, well, okay, let's try this amount, 12%. And so if you go to 12%, lo and behold, the net present value is equal to 0. Now, in our case, when we did net present value, we discounted everything at 8%. And it came back at a pretty substantial return, net present value of 60,000. So I knew it had to be something considerably greater than 8%. How did I know 12%? It was a guess. And if you're going to do Excel, pick a number. Excel, if you want to do internal rate of return, it will do it for you, but it'll ask you to sort of prime the pump, throw in an interest rate. It will go back and forth, and it'll calculate the internal rate of return. So what I want to do is, if I'm doing this the hard way, just keep picking an investment rate and calculate it until I get the net present value to equal 0. And in this case, it happens to be 12. So in this particular case, I would say yes, this would be an acceptable project because the internal rate of return, that is what the project itself is generating, is substantially greater than my required rate of return, namely 8%. Both under net present value and under internal rate of return, I would accept this project because it will increase the equity of the company. Now, both methods generally should give you identical results. Okay, the problem with comparing net present value and internal rate of return is when you have unequal lives. And what I mean by that is that if I were looking at a project of 8 years and one of, say, 5 years, and say, okay, which one is better? Well, the problem is that with internal rate of return, I can't make an assumption that, oh, when you take that money and get it back from this project, that you can reinvest it at the same rate. I don't know what I can reinvest it. I don't know what the opportunities are going to be. So one of the inherent weaknesses, if you will, of internal rate of return is over this issue of comparability when you have unequal lives of projects. Not a huge problem, okay, generally speaking, but it is an inherent problem if you're comparing potential projects. Now, again, does it indicate erroneous decisions? Only to the extent that you have significant differences in lifetimes. If I have equal lifetimes, then they will give me identical results. Now, payback is, we're looking at now payback and accounting rate of return. Do not, I repeat, do not look at the time value of money. This is simply looking at cash in, cash out. If it cost me $1 million to buy this project, how many years before I get my $1 million back? That's essentially payback. And if I have, let's say, $1 million as an investment, I'm going to get $250,000 per year. Okay, fine, it's going to take me 4 years. That's payback. Now, what does it mean? Well, generally speaking, any project that has a shorter payback period would be assumed to be less risky. And many times companies will set an arbitrary payback period to say we won't accept any project beyond, let's say, 6 years, 7 years. One strength of that is that the further out you go, the more difficult it is to actually predict what those cash flows are going to be. So given that inherent risk, companies kind of cut it off. Now the problem is they're also ignoring whatever returns might occur in those subsequent years, which could be substantial. So they may in fact really be rejecting projects which would have a positive net present value, but because they've rejected it, because it doesn't pay it back soon enough, that can lead to less than optimal decisions. Now, accounting rate of return is one that's sort of popular, but it's a little bit more confusing, but it's one that tends to use accounting information. And also, too, the numerator is going to be the accounting income divided by the investment. Now, generally, what this means is that I'm going to look at, if I'm buying a machine that's going to increase my cash flow, let's say by $200,000 per year. Well, fine, that would be my so-called increase in income, but then I would also have to subtract out the depreciation associated with that new machine. So generally, the way it's often done would be take the incremental cash flow, subtract out the depreciation, then I can divide it by either the initial investment amount or by the average investment amount. Now, it's probably the weakest of the four methods, simply because it's sort of making it out to be equivalent, for example, to internal rate of return, when in fact it's really not. Now, investors really like it. That's why companies still often talk in terms of accounting rate of return. Oftentimes, even within a company, they'll want to know what it is. So it is still very popular because, again, it's looking at the information that you would find, excuse me, on the income statement. If I don't have access to cash flows, maybe I can sort of finagle a little bit by looking at what's on the income statement. Relevant cash flows, I think we've talked enough about. These are things that are going to make a difference. The cost of the machine, the cost savings, okay? The things that are going to be different between the status quo and, let's say, buying the new machine, or the status quo and this investment if we expand. Now, taxes are potentially a problem. And in real life, that you have a situation where taxes tend to be a relevant consideration. And I kind of like this method to look at it, okay? And that is, if you believe that if I'm going to make this investment, it's going to increase my cash flows by $220,000. All right, well, fine. Then the amount of depreciation, actually, let's look at this one up here to start with, okay? This represents my income, okay? And with any potential investment, okay, I'm also going to increasing the assets themselves. So I have income coming in, but I'm also creating a new asset, which means that I'm creating additional depreciation, the $120,000 here. That $120,000 will shield part of that income from taxes. So that really all that's subject to taxes here are the $100,000. So at 40%, I pay $40,000. So my actual, excuse me, there are actually two relevant cash flows. The $220,000 coming in, the $40,000 going out. That's it. I'm not taxed on the entire $220,000 because I bought the new machine. Okay, I get to increase my depreciation expense. Depreciation is by itself a non-cash expense, but it shields certain. All right, sorry about that. But depreciation does shield a certain amount of my income from taxation. So out of that $220,000 of income, only $100,000 is subject to tax. Pay my $40,000 for it. That's it. In terms of cash flows, I only have $220,000 coming in, $40,000 going out. My net cash flows are $180,000. Now I can kind of look down here and say, okay, gee whiz, okay, what would it be? This is assuming that I have the $220,000. Okay, that I'm also going to pay the $88,000, so I'd have $132,000 left over, but it also takes the depreciation times 40%. It's a little bit more difficult to understand what it is that they're trying to get at. I personally like this method a lot better by just taking the change in income minus the change in depreciation gives me the amount of income subject to tax. Okay, the $100,000 is a relevant number. So that becomes my taxable income. Subtract out the 40%. I write a check to the IRS for $40,000. I'm left with $180,000. The initial investment, okay, as we talked about, the cost of the machine, the additional working capital, okay, and if I get rid of the old machine, okay, what that will tend to be an offset. These are going to represent cash outflows. This will represent a cash inflow. So they will be a sort of a net cost to me if I go with a new machine. Oops. Again, we kind of identified this in a couple of slides earlier, that yes, I have additional cash flow coming in, additional income. I also have additional depreciation. And like anything else, if I have more income, I'm going to have a little bit more tax. Okay, so those are all going to be relevant relevant information and deciding whether I make the investment or not. Now, we're not going to look at too much this. This gets a little bit complicated. I think when you take corporate income tax, you'll look at this issue. The disposal of an asset, okay, I have to recapture some depreciation. My investment tax credit, okay, what happens with all of that? So it's a little bit complicated, but understand that not only do I have the cash coming in from sale of the machine, but I may have to go back and recapture it. So I think that's pretty much it in terms of the theory of this chapter. So we're going to look at more so, I think, looking at the applications of this, looking at the problems. So like we did with budgeting, sometimes with these chapters, it's nice to talk in terms of theory, but I think it's a lot easier to understand the material when you see how it's done. So if you're still a little bit confused by how to do capital budgeting, we'll take a look at some of the problems from the chapter and discuss how you actually use net present value, internal rate of return, accounting rate of return, and payback period.